Hi again, welcome to our series on the Definite CCRI project for circular entrepreneurs. In our last video, we dove into the first part of the financial due diligence, breaking down market analysis into a TAM, SAM, and SUM. If you missed it, be sure to check that out. It's kind of crucial for helping you understand everything we're going to cover here. In this video, we're diving into financial modeling, an essential task to building a strong business case and attracting investors. I encourage you to follow this video with the help of the guidebook, which you can find in the description. I'll walk you through 6 key parts of financial modeling: estimating demand, identifying revenue streams, identifying components and drivers of revenue, cost modeling, understanding different expenses and their implications on cash flow, and lastly, reviewing the likelihood of projections. The first step, demand analysis. This is all about understanding your potential customers and their needs. This will give you an estimate of how many customers are likely to adopt the product or service and how often they'll use it. This forms the foundation for your revenue projections. So, how should you approach this? Firstly, quantify the demand. Start with your sum. How many potential customers are there? Multiply this by estimating how often they'll use or buy your product to calculate total annual demand. Secondly, understand what your customers need. What motivates your target customers? Is it cost savings, environmental impact, or compliance requirements? Align the product features with these needs to maximize adoption. Finally, address certain barriers. Learn what might stop people from using your product. Is it cost, lack of awareness, or competing solutions? Develop strategies to overcome those. The second step is revenue streams, where we'll identify and analyze all the ways your business can make money. This step ensures your revenue streams are realistic and sustainable over time. Let's find out how. Firstly, make a list of revenue streams. Don't hesitate to think broadly. Involve product sales, subscriptions, maintenance services, consultancy, and more. If you're running a new co-working space, it'll be the rent you're earning. If you're selling consumer goods, the bulk of your revenue streams will come from selling those products. Secondly, build pricing models. Research competitor prices and gather customer feedback to decide on pricing for each revenue stream. Start from benchmarking similar products on the market. If your solution is highly innovative, try and infer it from the monetary benefit users would get from using your product. Lastly, forecast your revenue. Try and estimate the number of customers, their average spending, and usage frequency over a defined period. Normally, you would like to forecast at least 5 to 10 years. Factor in customer acquisition rates, market growth, and pricing changes. The third step is the direct costs and gross margin. This will tell you how profitable your offering is and helps guide your pricing strategy. Again, there are 3 steps to follow. 1, identify the direct costs. This includes raw materials, manufacturing, logistics, and packaging costs. For example, the production cost of a reusable wrap might include fabric, stitching, and quality testing. 2, calculate the gross margin. Subtract direct costs from revenue to determine gross profit. Divide gross profit by revenue to get the gross margin percentage. And 3, compare gross margins with industry norms to ensure competitiveness benchmarking with others. The fourth step is to identify and project your costs. These costs are conventionally split between CapEx and OpEx. Capital expenditure, also known as CapEx, refers to the big investments you'll make to scale your business, like facilities, equipment, or software development. Proper planning here is crucial. But how can you identify your CapEx? Well, first, identify capital needs by listing major investments required. For instance, CapEx for a hospitality project could be building renovations and solar panel installation. Secondly, estimate costs by getting vendor quotes or use industry benchmarks. Always add a buffer for unexpected expenses. Third, plan for depreciation by spreading the cost of these investments over their useful life and factor that into your financial projections. Next to the CapEx, you also have operational expenditures, known as OpEx. OpEx refers to the ongoing expenses needed to keep your business running, such as salaries, rent, utilities, and maintenance. Managing these costs efficiently is key to profitability. Now, how do you identify your OpEx? Well, first, categorize recurring expenses by listing all operational costs, including payroll, office supplies, marketing expenses, etc. For a hospitality project, OpEx might include housekeeping wages and utility bills. Secondly, track and optimize costs by regularly reviewing expenses to identify cost-saving opportunities, such as negotiating vendor contracts or improving energy efficiency. Third, forecast and budget, where you analyze your historical spending patterns to predict future expenses and ensure your cash flow can support ongoing operations. The fifth step is building financial projections. This will give you a full picture of your business's financial health. Investors will scrutinize this, so accuracy is key. Here's what you need to include. Projections for profit and loss, known as P&L statement. This shows revenue, costs, and profitability over time. Key items in P&L are revenues, direct costs, gross profit, operation expenses, depreciation and amortization, as well as the net income balance sheet, which gives a snapshot of the company's assets, liabilities, and equity over time. It shows how well you manage your resources. There are some concepts you'll need to know before you can talk about financial projections. This consists of two parts: assets and liabilities. In assets, you have the current assets, which is your cash, accounts receivable, and inventory. Fixed assets includes long-term assets such as equipment, buildings, and IP, intellectual property. Within liabilities, you have current liabilities, including accounts payable, short-term debt, and accrued expenses. Long-term liabilities includes loans or other obligations due beyond a year. And finally, equity, including founder investments, retained earnings, and external funding. Now, you can use all of these concepts to build models. Firstly, the project assets. Use industry-specific ratios for current assets relative to revenue. For example, accounts receivable might be certain days of annual revenue in a subscription-based business. Fixed assets should align with CapEx investments, factoring in depreciation schedules. Secondly, project your liabilities. Short-term liabilities, such as accounts payable, are often tied to direct costs. A common assumption is that accounts payable represent a certain number of days, typically 30, 60, 90, of cost of goods sold, COGS or COGS. Long-term liabilities should reflect the payment terms of loans or leases. Finally, calculate your key ratios. Divide your current assets by current liabilities. This is your current ratio. If this ratio is above 1, it indicates sufficient liquidity. Second key ratio is the debt to equity ratio. To calculate this, you have to divide your total liabilities by your total equity. This highlights the balance between borrowed and invested capital. The final and sixth step is to ensure you can handle cash as carefully as possible. Here are the 6 key considerations to help you do that. Firstly, set up your cash flow statement to track the cash moving in and out of your business. It shows whether your business has enough liquidity to cover operational and investment needs. Secondly, define your structure by following these activities. 1. The operating activities, showing the cash generated or used in day-to-day operations. This includes net income, adjustments for non-cash items like depreciation, and changes in working capital. Second, investing activities, showing the cash used for CapEx, acquisitions, or other long-term investments. Third, financing activities, summarizing the cash inflows from loans, equity investments, or outflows for loan repayments and dividends. Thirdly, define the project operating cash flows by starting with net income from the P&L. Adjust for non-cash expenses, for example, depreciation, and changes in working capital. For instance, if revenue grows, accounts receivable and inventory may also grow, reducing cash in the short term. After that, project the investing cash flows by reflecting on CapEx investment as negative cash flows. Use depreciation schedules to match cash outlays with assets' lifespans. Remember to include expected inflows from asset sales or grants. A fifth consideration is projecting financing cash flows by identifying the funding requirements for projected cash deficits. Also include inflows from planned equity raises or debt financing and outflows for repayments or dividend payouts. Again here, calculate your 2 key ratios. First one is your free cash flow. You calculate this by dividing your operating cash flow by your CapEx. This measures the cash available for reinvestment or redistribution. The second key ratio is the flow coverage ratio. Divide your operating cash flow by your total debt. A higher ratio signals better debt repayment capacity. And there you have it, a clear roadmap for building a rock-solid financial model. Remember, it's not just about numbers, it's about telling the story of your business's potential. Before I go, I want to leave you with some tips. First, be conservative. Avoid overly optimistic assumptions. Use realistic growth rates and cost estimates based on market data and industry benchmarks. Secondly, use sensitivity analysis. Test how changes in key variables like slower revenue growth or higher costs might impact your projections. This helps you assess risks and prepare contingency plans. Last, but not least, visualize the data. Feel free to use charts and graphs to present key financial trends. For example, revenue growth, EBITDA margin, enabling a better interpretation for the stakeholders. In conclusion, strong financial modeling isn't just about numbers. It's about telling a compelling story that attracts investment and supports the long-term viability of your circular project. If you want to deep dive into how to create the P&L statement, balance sheet, and cash flow statement, the guidebook can help you. Also, be sure to hit follow or subscribe to stay tuned for the following videos. In the next video, we'll provide information about company valuation, capital raising, and use of funds. See you there.